So Andrew, what is it that we always try to let our audience know when it comes to the retirement planning process in our videos?
Well, we like to keep it simple.
Absolutely. Except in this case here, when we're talking about interest on your money, we don't like to keep that simple. So in today's video, what we're going to show you is the difference between compound interest versus simple interest. Now, to understand, both types of interest will grow your money, but one type is going to give you a much bigger bang for the buck. And so you're going to want to stay locked into today's video so you can understand the difference between compound interest and simple interest. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing retirement process simple.
Absolutely, and we do this simply by incorporating a team of strategic partners ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a comprehensive and holistic roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrew, when we're talking about interest, it's basically the cost or the benefit of you actually using money. So when we're talking about your own deposits, like your checking and savings and other investments that you may have, then you're going to want to make sure that you're going to take a look at the compound interest of those dollars. But if you're talking about student loans, credit cards, your mortgage, your auto loans, you're going to want to make sure that simple interest is going to be in that particular equation. Now, understand the calculation of compound interest is definitely a lot more complicated than simple interest. That's why we have calculators, right?
Right.
So, but what we're going to look at is that the vast difference of your money when you compare the two. So you're going to want to take a look at what we're going to talk about today as we compare how your money would perform when it's getting compound interest versus it getting simple interest in today's video. But before we dive into that, Andrew, what are the 2 rules of money that we like to give our audience?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
So let's go ahead and talk about the vast difference between compound interest and simple interest. So now we're going to talk about compound interest versus simple interest. This is going to be a very interesting lesson today, so definitely pay attention. So we have compound interest that we're going to talk about first, and we're going to just briefly go over this again because we talked about it in our prior video about compound interest that I would encourage you to definitely go take a look at if you have an opportunity. But we talked about this. It's calculated on both the initial principal and the accumulated interest from a previous period. That's how compound interest works. Now, again, I'm going to go through this quick example. If you have $1,000 in year 1 at 5%, it'll be $1,050. In year 2, that $1,050 is allowed to grow with compound interest, and it becomes $1,102. And if you just take it out to one more year, you can see that the $1,102 is now going to be the high water mark, and that compound interest with the 5% is going to be on that number, and it becomes $1,157, and so on and so on. Now, with simple interest, it's just like its name. It's very, very simple. It's calculated based only on the principal amount. So it's not calculated on the interest. So let's take a look at the same example here. When we're dealing with simple interest, in year 1, everything is the same. You feel like, okay, I didn't lose anything. That $1,000 at 5% will be $1,050. But here's where it changes very quickly. In year 2, you're only able to earn $50 again off of that $1,000. You don't earn any interest off the $1,050. It's simple interest. It's off the principal amount only. So in year 2, instead of your money being $1,102 over here, it's $1,100. And in year 3, because you're not having any interest on this $1,100, in year 3 you earn another $50. And so that amount is $1,150 versus your money being $1,157. So you can see that compound interest is starting to pull away slowly but definitely surely. And so when you are talking about your money or your deposits, you're certainly going to want to have that into a compounding interest situation. But when you're talking about debts, such as credit cards and other debts, you're certainly going to want to have that in the category of simple interest. So now let's go ahead and continue our discussion on a more intuitive basis. Pay attention to this for sure, because it's really going to highlight how the vast difference over time that compound interest versus simple interest will make with your money. So let's look at the compound interest here. We're going to look at the initial deposit of $5,000. We're going to only look at a time period in the first example of 5 years, interest rate of 5%, and we're going to keep it simple. We know that compound interest has different frequencies that we can use, but we need to make it, we want to give simple interest a chance in this example here. So we're just going to make the compound interest frequency as annual. So at the end of that 5 years, you can see that the value of that $5,000 has grown to $6,381. Now let's take a look at a simple interest scenario. $5,000, 5 years, everything is exactly the same. At the end of 5 years, you can already see the compounding interest effect. You only have $6,250 when it comes to the simple interest, a difference of $131 or so. So you're thinking to yourself, that's not really a big deal. And I would agree with you, but you don't stop saving in 5 years. So let's keep moving. So now we're going to take a look at the same exact scenario, but now we're 10 years out. Same interest that you're receiving, annual basis. At the end of that 10th year, now we're talking about that $5,000 being $8,144 and some change. Now we're going to look at 10 years out with the simple interest, and as we can see, at the end of that 10th year, now your value for the simple interest is only $7,500. Now we're starting to grow a little bit. No one wants to give away $644, I don't believe, but that's what you're starting to see. Now you're $644 difference. Now, we know that people don't save just for 10 years. Your retirement, for the most part, people start saving, let's say in their early 30s, they're going to retire in their 60s. We're talking about 30 years of savings. So let's take a look at the compound effect 30 years later. Same exact interest rate, have the annual basis. That $5,000 over 30 years without you adding anything to it, we're not talking about you adding anything to this account, would have been valued at $21,609. Now we're taking the same look at a simple interest contract. Your $5,000 would have only been $12,500. We're talking about now over a $9,000 difference. So I don't know who's watching this video right now, but whomever is watching it, I don't think you want to be in a situation where you're giving away, over $9,000 of difference in growth of your money because you have chosen to have any type of scenario where you're only getting simple interest versus compound interest. So as we always say, no matter what your situation may be, you're going to always want to consult with your own financial advisor or tax advisor just to make sure you know exactly what may be suitable for you. So I really hope that this video shedded some insight on the vast difference between compound interest versus simple interest. Please remember that we do these videos for educational purposes only, and that you should always consult with your own personal financial advisor or tax advisor about your unique situation. For more information on this subject matter or any topics that we've covered in our prior videos, please do not hesitate to reach out to our office or leave any questions or comments in the section below.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement savings, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.